Choosing the right mortgage can seem overwhelming, especially when there's so many options like FHA, VA, and conventional. My name is Quann, and today we're going to be breaking down the different types of loans to fit your lifestyle, your needs, and your budget. Stick around, because at the end, I'm going to go over the biggest mistake buyers make when choosing the right loan. Let's get into it. All right, a good buddy of mine named Nick Lewis sends out a loan summary every Saturday morning. It's something that I actually look forward to. I get bombarded with emails every year. But this is one that I actually look forward to every Saturday to kind of go over rate scenarios and what they're looking like going into the weekend. He based all these on a 450 sales price, so that is something to keep in mind. But it's going over 3 of our major loans: a VA, which you got to be a veteran to use; conventional, which is usually your more heavy down payment; and then you also have an FHA. FHA has typically gone with first-time home buyers, but you don't have to be a first-time home buyer. Now, we have 2 scenarios here that we'll go into, but one is a first-time homebuyer program, and then one is just a standard FHA, and that is your 3.5% down payment option. They're also pretty lenient on credit. I've heard of programs going all the way down to 580 credit scores, but let's go on like a 620 or 640 credit score from here on out. And they allow a higher debt to income. Now, we're going to talk about all these things, but that's the 3 different loans that we're going to go over today, with the caveat of the grant program that I've put in there to kind of show you a more 100% financing first-time home buyer scenario. Now, there is things to consider when we're talking about loan. A lot of folks get held up on just, say, the down payment, but you do need to realize that all loans have things that are called closing costs. And if we go over to, say, this VA, which is 100% financing, and look at, let's say, more information and then type closing cost, here are things that are going to just be added in. In a VA, you have a thing called like a funding fee. In some places, it could be a mortgage insurance. And these are your prepaids. So hazard insurance premium, taxes, reserves, so you're building out those escrow accounts, appraisal fees, buy down if you are doing a buy down with, like, say, the seller, condo fees, if you're getting any sort of credit report, flood certification, realtor fees, survey fees, processing fees. All these kind of total up, lenders fees, title fees, all sorts of fees in there. And almost every loan in the history of loans is going to have some sort of closing cost. So while it's a 0% down financing option, there still are closing costs that are associated with it getting the deal done. A good rule of thumb is 3%. So on a $300,000 house, it could be $9,000. On a $400,000 house, it could be $12,000. Now, this is going to change for every property. As you see, there's certain taxes, certain escrows we're setting up that are just going to change a little bit. That is one thing to note here. While it is 100% financing, you're typically not walking to that house with no money down. That could help cover some of these closing costs, and that's where you truly can get into 100% financing. But you got to know the market, and that's where working with a local lender and a local real estate agent is going to help. If we're in a seller's market, usually sellers have the pick, and they're probably not going to give you credit. Where if we're in a buyer's market, that buyer's in the driver's seat. They can dictate more things, and one of those things could be closing cost. And if the seller wants to get the deal done, they sometimes will give you closing costs. Now, prior to the big run in 2020 and 2021 and 2, it was very typical in our market to get closing costs. If we gave them a good offer, typically they would cover the closing costs for the buyer. But when we got into that hotter market, buyers always end up paying their own closing cost. So all that being said, we're getting away from the loan scenario, but I just want you to know, typically with any loan, there's closing costs associated with it. Okay, so let's just look at the blanket options, all right? Conventional, 30-year, these are all 30-year products, 20% down with 0 points. Point is a percentage of the loan, and that usually goes into buying down the rate. So today's example is a 6.75 on a conventional. Maybe they could put 1 point towards that and get a 6.5. It's going to be different for every loan scenario, so I don't want to get caught up on that. Just know all these are 0 point options here. So the conventional loan is a 6.75. It is typically your higher rate, but you have no mortgage insurance. Mortgage insurance is a type of insurance that the mortgage company will place and to help them in case of the borrower to default. Now, there's a couple different ones. You have your privatized mortgage insurance, and that is your conventional scenario. It is a little bit higher, and that's why it's incentivized to put 20% down. Now, once the borrower has 20% down, whether they put it down or they built equity in that house, that mortgage insurance drops off. So it's kind of a fee that you don't really want to pay, but every loan's typically got it, except two exceptions, 20% down or more, or if you're VA, which they have something different that we'll get into. Federal housing, or FHA mortgage insurance, is exactly that. It's a federal-backed mortgage insurance that the federal government's actually going to help insure these properties. One key note with an FHA versus all the other loans is the mortgage insurance on a FHA loan is for the life of the loan. It does not drop off at any point. So ideally, you're going to want to refi at some point down the road and get that mortgage insurance to drop off. Now, VAs have a thing called a funding fee, and that's kind of an upfront mortgage insurance that they charge. The one thing to note with that is if you are disabled, I believe, and this is something you'll want to check on, anything more than 10%, you can start getting discounts. If you're at 100%, you usually have no funding fee. Another thing to note is the first time that veteran buys a house is the cheapest mortgage insurance that they'll have. It goes up every time they use their VA from there on out. Now, typically VA is going to have the best rates out there. And as you can see on this scenario, it's a 5.99, which is a very great rate for today's standard. The FHA is usually right behind it, but again, they have a higher mortgage insurance, so it kind of offsets on where it could be a more expensive scenario depending on the borrower's line. Like I said, conventional is very credit driven. You get better rates and lower mortgage insurance if you have a borrower, say, in like the 750 credit range versus a 620. That's where an FHA might want to kick in, because if you have a borrower with maybe a lower credit score, FHA actually comes in handy because they're not credit driven at all. Typically, the rates are what they are. There are few scenarios where if you put a little bit more down or you have stellar credit, you might be able to get a little bit better interest rate or a little bit less mortgage insurance. But for the most part, the rates are there. They are. If you qualify for the house, you get that kind of rate. So let's get into the big one. Obviously, it's a $450 price point. If we look at the payments, conventional is going to be the best, but they're also putting 20% down. Key to look at here is cash to close would be $103,000. If we go to VA, that is the second best option here. Again, you have to be a veteran, but $31.46. But look at the cash to close. This is the money that will actually be due at closing, $13,000. Now, if we were to get, say, a credit from the seller, that's where we can get that down even more. But ultimately, this is the closing costs that the buyer is expected to bring to closing. FHA, which is at 3.5% down, it is the highest on this chart, $3,300, and your cash to close is $29,479. And again, that's a 3.5% down payment. So on a 450 times 0.035, it's $15,000 out of that $29,000 is the down payment. But there are a pile of different loans out there when it comes with FHA, and they are state driven, they are federal driven. They have a certain amount of money that they're allowed to lend out. And so it gets a little wild. And that's where you just really need to talk to your local lender. But in this case, there's a federal first-time homebuyer grant of $17,000. Now, if we can get a credit on that from the seller, we can get that even lower. But that is the closing cost that's due from the borrower at that point. So there are really cool options out there for first-time home buyers. VA is obviously, if you're a veteran, that is the way to go. The other option too is conventional has a 3% down first-time home buyer. It's called the Home Ready program. Now, for all these, you can do different terms as well. These are all 30-year notes, which is your typical loan. That's what most homeowners are going to go with these days. But you can do 15. You can actually do other ones too, but a typical one's, say, a 30. Some people do 15, which isn't technically doubling up the payment because there are other fees that are involved in here. But if you want to try to get your loan knocked out in 15 years, it is great. And that's where you really need to start thinking, is this your forever home? How long am I going to be in this house? These are all questions you need to ask before choosing a loan. Sometimes I don't want to take all my cash out and put it just to save $500 a month when I know I'm only be in that house for 2 or 3 years, because that's never going to equal out. Now, you are building equity into the house, which is good, but sometimes maybe your cash is earning more money than, say, 6.75 or 6%. So you leave it invested and you kind of take the higher hit on the payment, hoping that one day maybe you can refinance or you're going to sell the house and get out. These are all scenarios that a good lender is going to be running for you. How long are we going to stay in the house? What do you want to keep your mortgage payment? What do you want to keep your cash on hand? They're going to know all those scenarios. You're going to let them know how much assets you have. These are things that a lender is really going to dive deep into doing for your scenario. Here's a cool chart right here with the interest and mortgage insurance paid over the last 15 years. Here's Nick's reviews and savings over the next 60 months, what you can expect as well. So typically Nick is going to run a couple different scenarios before you're locking in that loan, kind of showing you what is best for you to use. A couple mistakes I see people make all the time. Worrying about just the interest rate. People get so hung up on the interest rate, but don't realize that they've paid, say, those points to get the interest rate down because that's what the lender thought was a better scenario. While their rate was a little bit better, you technically paid for it. Also, junk fees that are thrown in there. These are things if you are pricing out two different mortgage lenders, you can compare them side by side. Any lender should be able to give you a breakdown like this or something like this to kind of show you different scenarios. So if you're pricing out two different lenders, put them side by side. Don't just get hung up on just the interest rate or just the cash to close. They're all going to be a little bit different, or they could be the exact same, but you need to compare apples to apples, not apples to oranges. One thing I preach on this channel, and I feel like many realtors do, is the importance of getting pre-approved. Obviously, these all change dramatically depending on the borrower, depending on the credit, depending on the assets they have. There's also loan programs we haven't talked about that might be just for certain areas. We won't know any of this until you get pre-approved to make sure you either qualify for it or in some cases are overqualified for it. Some of these have income caps per county, and that's where it's like, we don't know until we know what you're qualified for to be able to guide you on any of this. So I never tell borrowers to go look at houses until they're pre-qualified. We need to know their loan scenario to know what we need to look for. I would hate for you to find the house just to turn around and realize that we can't get a loan for it. A good example might be like an RD loan. There's very small area that you can't use that here in Virginia. Or there might be like an income cap of those counties, say $100,000 household income, and you guys make 110. Just like that, you found your dream home and we can't even look at it, or we can't even put a contract on it. The biggest myth is, and I unfortunately kind of lean to it here, is with a conventional loan or any of these loans, you need to put 20% down. There is so many options out there that you don't have to put 20% down. And for the most part, once you go under contract, they're all about the same. There's a tendency that a VA loan's a pain in the butt. A VA loan's a great loan, and they are very good if you have a good lender. They are a little bit lenient on the borrower, but they're stricter on what the borrower is buying. They send out an appraiser. They're looking for a few other things that other loans are not checking. Because in a conventional scenario, they're putting 20% down. The bank's going to be a little bit more lenient because you have more skin in the game. And they know, hey, look, if we lose, they're going to lose pretty hard too. Choosing the right loan is one of the most important steps in your home buying journey. With a clear understanding and a good local lender, you can choose the right options to fit your unique situation and to make a confident decision on the loan that you're going with. For more tips on home buying journey, check out my last video on your financial steps to home ownership. Thanks for watching. I'll see you on the next one.